Welcome to this session on net zero transitions. I think we will get started. My name is Jinu Koola. I am from Norges Bank Investment Management, and I will be moderating this session. So as part of my role, I will try to keep time. We'll have two parts to this session. The first one will be to take a look back and discuss what we've observed in the market. And then we're going to try to take a look ahead at what the future might bring. Following the paper presentations, we've also reserved 20 minutes at the end for a moderated discussion with this distinguished panel and for some audience questions. So let's begin. Let's begin first with what we've observed. Professor Bolton and Professor Kacperczyk will present their paper on the global pricing of carbon transition risk, and Dr. Thallinger will discuss it. So let me briefly introduce them. Professor Bolton is a professor of business at Columbia Business School. Professor Kacperczyk is a professor of finance at Imperial College. Both together and separately, they have published several papers related to both climate risk and net zero. Dr. Thallinger is a member of the management board of Allianz and was previously Allianz's CEO. He also currently chairs the UN Net Zero Asset Owner Alliance. We've reserved 15 minutes for the authors to introduce their paper and the key findings, and 5 minutes for discussion. So with that, gentlemen, the floor is yours.
Thank you very much, Jinu. And let me try to share the screen. And where is the full screen here? Okay. Oh yeah, okay. Sorry. All right. Yeah. Okay. Thank you very much, Rob. Thank you very much, Richard, for having us out. It's a great pleasure to participate in your exciting events. For 20 minutes, I'm gonna be Patrick Bolton. My link, unfortunately, did not work well, so we decided to go under the same link. So I'm gonna talk about research that Patrick and I have been involved in over the last couple of years that essentially is about carbon transition risk. So yeah. Okay, so as this conference is really a very specialized conference, I don't need to introduce the topic of global warming, which of course is at the front of a lot of discussion these days. I just want to argue that a lot of what we are discussing today is motivated by scientific evidence that tells us that there is a very tight link between what we produce in terms of carbon emissions and how temperatures change globally. And as an endorsement of this particular idea, last year we had a Nobel Prize in Physics awarded to two scholars who essentially have spent quite a bit of their efforts talking about this kind of ideas. So we take this scientific evidence as given, and clearly we are trying to do something about it because the physical changes in the atmosphere that we observe are actually quite dramatic. And there has been quite a lot of discussion around this idea of decarbonization. I think one of these significant kind of events are centered around the conference of the parties. So we had so-called Paris conference. Recently we had a Glasgow meeting. Both of them are reaffirming this idea that in order to stop these physical changes from disastrous consequences, we need to aim what we call the net neutrality within a certain time period. So we as a society have kind of agreed on the contract that maybe this is where we want to go, but what I think we know a little bit less about is what are the financial consequences of this kind of transition. And that's essentially what constitutes transition risk, both for corporations and for investors. So what are these dimensions of risk we are talking about here? One is the cost at which we will have to decrease emissions globally, and will this actually process of decarbonization go at a fast enough rate? The second one is how do perceptions of and expectations of the participants in the market determine the value of that particular cost. So just to give you a visual inspection of what this path of decarbonization may potentially look like, these are various simulations done by IPCC, which tell us what we should be doing in order to actually get within a certain level of temperature increase over the next couple of decades. And the path on which we are actually specifically focusing on is the bottom path, which tells us what should be the path of decarbonization to stay within 1.5 Celsius limit. And what's important to recognize in this graph is, of course, that these emissions have to go down, but I think it's also important to recognize the fact that we need to have information about how we are actually moving on that particular path. So this is kind of what constitutes a big bulk of our research that Patrick and I have been conducting over the last couple of years, which is kind of embrace what we know from the past, which are the emissions, together with what the future is going to tell us, which is subsumed by the subsequent disclosures of emissions by individual players, as well as by the commitments that they may potentially make in terms of their future decarbonization behavior. So we are going to study these questions related to these three objects of decarbonization using a large panel of data globally over the period 2005-2018. And there are three questions that I would like to talk a little bit about today, which relate largely speaking to the pricing of this carbon transition risk, which could be reflected in either returns or the valuation ratios of companies. We want to shed a little bit of more light on the mechanisms that drive this carbon transition risk. And towards the end of my talk today, I'm going to talk a little bit more about the role of carbon disclosure and the firm commitments, which especially has become recently on the center of the discussion given the SEC regulation and other movements globally. So how is it that we want to think about this transition risk? Essentially, from the perspective of emissions, you can distinguish between two sources of risk. One is going to be captured by the kind of level effect of emissions, which is how far we are moving or how far are we actually from the net neutrality. So level is going to inform this long-term kind of risk that companies have to deal with. But of course, that long-term effect is going to kind of distribute over time. And that's why it's useful to look at the short-term changes in the way of how this decarbonization process works. And looking at changes is going to tell us something about the short-term risk associated with transition risk. And what we are going to argue is that financial markets are going to be very vigilant of both types of risk, and potentially investors who have embraced this decarbonization or transition risk are going to require compensation for bearing this kind of transition risk. So, of course, you may argue that this effect is not going to be homogeneous across all the different jurisdictions and firms. And what we want to argue is it's going to depend on a number of different modifiers. So one way to think about it is to think from the perspective of the cash flows. So the idea of technological progress or the policy framework is going to be one of these modifiers that we can think about in terms of heterogeneous responses. On the discount rate kind of basis, we can think about investors' perceptions as modifying this particular exposure to transition risk. So in our research, we are trying to inform a little bit this discussion quantitatively and see to what extent these factors actually matter for what we observe in terms of the pricing of transition risk. So how are we going to do this? We are going to look at an empirical data that largely is going to be the data on emissions and various information pieces around emissions. So the main data on emissions is going to come from true cost. Information on commitments is going to be initiative specific. So we're going to look at CDP and SBTi as commitments. And finally, we are going to try to absorb as much as possible the firm level variation that could potentially modify this risk. And that information comes from a fact set. So in the end, we are going to be working with a very large panel of firms. We are talking of roughly 14,500 globally publicly listed companies. And in terms of the economic scope of this exercise, we are talking about, roughly speaking, 90% of the total market capitalization. What's important here is that the activity that we are going to be capturing covers a very large set of countries and pretty much all industrial spectrum. So just to give you some idea how this long-term and short-term risk effects distribute, here is the basic correlation structure of Scope 1, Scope 2, and Scope 3 emission for the levels and the changes. And what you can see nicely here is that, of course, across three levels of scope, we see a strong correlation within the long-term and short-term risk spectrum. But what's kind of more interesting is that if you compare the level effect to the change effect, the correlation essentially is close to zero. which gives you an idea that, roughly speaking, we can think of these two sources of risk as potentially independent. I'm not going to show these results today, but we have actually verified it in some of the research that if you try to explain the pricing effects due to transition risk kind of in the model that jointly includes these two sources of risk, they independently capture different variations in the data. So how are we going to empirically estimate transition risk? This is going to be a very simple exercise where we are going to be looking at monthly stock returns or valuation ratios, and our main variable of interest is going to be lagged carbon emissions. Either we look at the past levels or the past changes, and as I said, we will try to absorb as much as possible of the additional variation in the data. And the coefficient on this emission metrics is going to tell us something about the value of this transition risk. So here is the kind of headline result from one of the research that we have done, which shows you what's the relationship between the returns monthly and the level of emissions. And what you can see throughout for scope 1, scope 2, and scope 3 emissions is the positive and statistically and economically strong effect on returns. So essentially, investors in companies with higher levels of emissions require higher compensation in terms of returns. Interestingly, if you absorb additional industry differences across companies, you see that this effect actually improves in terms of economic significance. And we are talking, roughly speaking, about 2 to 3 percentage point differences per one standard deviation in emissions across firms. And similarly, we find very strong results when you look at the short-term measure of risk measured by the percentage changes in emissions, which gives us a confidence that this is not just about some kind of stationary or permanent characteristics of the company, but it's actually also about the innovation in the risk that potentially informs investors in the process. So we verify this idea of expected returns by looking at the valuation ratios. So here is the basic result where we look at the book to market of a company. Essentially, we're trying to see whether there is underpricing of these companies at date 0 when transition risk actually originates. And we find evidence that is actually consistent with this story. Companies which have higher emissions have lower prices today. So then we try to understand this process a little bit in the spectrum of the global data that we have. So a couple of headline results I want to mention. First, we find that these effects are actually quite widespread. We find strong transition risk in pretty much all geographic locations, maybe slightly weaker when you look at Africa and the southern hemisphere of South America and Australia. Then, of course, the question of interest to a lot of people is to what extent these effects depend on the degree of the country's development. And we find that this actually does not matter much if you talk about the long-term transition risk. There is some difference across countries when we talk about short-term transition risk. Countries that are more developed are actually exposed to a smaller transition risk. We also try to look at these different components of transition risk, as I mentioned, technological, policy, political aspects of this. And let me summarize it in a short kind of fashion. So what we find is essentially that technological risk, political environment, they matter for short-term risk. On the other hand, something like policy tightness around the climate or investor awareness, which we proxy for using Paris Agreement shock, are more important for a long-term transition risk. So then in the second part of our research agenda, we wanted to understand to what extent the information about emissions matters for this pricing of transition risk. So here we are looking at the role of disclosure and firm commitments that are issued by companies. So starting with disclosure, there is of course the obvious economic intuition that if more information is being disclosed to the market, we should expect a reduction in uncertainty about these emission levels. This disclosure actually could come in two forms. It could be voluntary. This is actually something that firms decide to do on their own. And by doing that, of course, it's going to affect the uncertainty, but also may also signal their stance on this issue of climate. But it can also be mandatory, which is just then strictly related to the uncertainty of this process. So how is it that we want to think about this disclosure in terms of the economic framework? On one hand, the disclosure is going to provide more information. So as I said, we are reducing some uncertainty. And of course, emissions are persistent, so the big component of this disclosure is going to be about the innovation component. And on the other hand, we can also think about the legitimacy, to the extent that some of the stakeholders or shareholders of these companies may want to engage in some kind of active campaigns related to decarbonization. Disclosing information is going to be actually a stronger mandate for them to do that. So we try to understand to what extent actually companies' changes in the disclosure frameworks affects the cost of capital of these companies. So we are looking at the effects on both expected returns and valuations. So again, here is the kind of headline result that centers around this short-term kind of changes in emissions upon the disclosure of this information. And what we find is a very strong economically and statistically significant effect related to this disclosure. Upon disclosing that information, companies witness a reduction in their cost of capital, and that effect is actually very large. And then you can distinguish between voluntary and mandatory disclosures, and here we are taking the evidence from the UK market, where in October 2013, the UK regulator has actually imposed a mandatory rule on all the publicly listed companies in terms of their Scope 1 emission disclosure. So we want to understand to what extent that rule has actually affected the cost of capital of the companies that were forced to actually disclose. So here we are comparing companies that have previously not disclosed, they are now treated, to those that have actually previously disclosed around the shock that happened in 2013, and that's what we call a standard definitive kind of difference in differences estimation. So if you look at this particular result, and these are the ovals that I circled the main result of, you can see the result that is consistent with this uncertainty channel, which is companies that previously did not disclose but now disclose are witnessing a significant decrease in the cost of capital. That's the blue oval. But interestingly, that reduction actually is significantly smaller if you focus on companies that had higher emissions to begin with. So in some sense, there is a little bit of an adverse selection that is happening in this market that investors are recognizing, that the bad types are kind of punished for their misbehavior. And in the last part of our research, we want to understand how the disclosure may actually motivate additional actions of the firms in terms of decarbonization. So here we are talking about commitments, which are largely inspired by the country level initiatives. And we want to understand to what extent the commitments actually can also be important in the spectrum of the firm level behavior. So we are focusing on two kind of prominent initiatives in this field, which is the Carbon Disclosure Project and Science-Based Target Initiative. And we want to ask questions: what motivates companies to join commitments, and what are the real consequences of this kind of commitment drives? So here are the three headline results I want to show you. The first one, which is very interesting, is the aggregate evidence. So what we observe here is the rate of change in terms of the commitments of all the companies relative to the rate of change in terms of emissions of all the emitters, not only those that commit. And what you find here is something somewhat disappointing. Even though the rate of commitments goes up, more and more companies are making commitments, that does not actually lead to a significant reduction in their emission. Quite the contrary, the two are actually moving almost for most of the times in a positive lockstep. So that tells us two things. Either the decarbonization process is still in these early stages, so the commitments are not yet meaningful enough, or maybe there is an interesting selection that drives this effect, in a sense that companies that actually commit are not necessarily the companies that are responsible for the most of the emissions. So this is what we are looking at the data, and this is a broad kind of main headline results coming from this result. So column 5 and 6 are the ones I would like you to focus on, which effectively tells us that companies are less likely to commit to these initiatives. This is both for CDP and SBTi, if the level of emissions is higher. And that's conditional on being in a given industry. So in other words, we want to argue that who makes a commitment is usually a best-in-class type of player. So not necessarily the one that we would like to decarbonize. And to finish off, we would like to see whether these commitments actually have a meaningful effect on the corporate emissions. So we are looking at the evidence where we try to see whether companies that make commitments subsequently reduce their emissions in a 1 year and 3 year period horizon. And the result of that is generally yes. Companies that actually make commitments, they reduce their emissions, But interestingly, what we observe is that that reduction in emission is particularly strong, again, for the companies that have lower emissions to begin with. So again, the best players are the ones that are actually willing to reduce these emissions, maybe because they know they can do it. However, the ones that we would like to reduce from the perspective of the global effects are not necessarily engaging in this reduction. So let me conclude by saying that we find strong evidence throughout our research agenda that transition risk is already becoming a material risk for a lot of players globally. It is, of course, a challenge how to measure that. We need to make progress on that, and I think the policymakers globally are actually concerting around this particular idea. That disclosures is clearly a very important aspect of that, as well as are the commitments about the future decarbonization. What we basically take away from our paper is that finance can actually play a big role in this particular process of decarbonization. We had a very interesting session on the macro kind of aspects of that. I think one of the challenges, of course, we see from the kind of macro policy perspective is the cost of coordinating these actions. So in this regard, the financial sector could be actually a nice alternative that is trying to bypass this coordination cost. So you can think of these effects that we document in our research as an alternative way to think of some kind of a carbon tax that the companies can actually face. Thank you so much, and we look forward to the discussion.
Yeah, thank you indeed. Really, thank you for this discussion here and for the paper. If I may come and start out from, let's say, a market perspective to explain how timely the paper is. It is indeed the case that not only there are many of these net zero commitments and pledges, it's also that many investors by now have, for actually their entirety of portfolios, such forms of commitments. That means these type of investors really need to start to get to a basis and then also to an, let's say, a tool set to be able to run kind of stress tests on their carbon risk. And the paper, as we have seen it, gives, I believe, actually a very good basis to exactly start to work on these type of stress test analysis that then may help to really focus on areas across portfolios that need very particular forms of management. Now, what is certainly very helpful in this context is to have, let's say, this focus on emission growth and also on the absolute level and the distinctions made in the paper that certainly will inform this type of stress testing activities that indeed need to be done fairly soon. I do believe the paper also helps very well to develop know-how around the understanding of carbon risk as an element of an entire set of KPIs for portfolio steering. Just one example, as was just mentioned and explained, given that the absolute level apparently really, let's say, provides quite some indication that a company is not going to make commitments, shows that the market at large, and then we can look into sectors, at least from a practical perspective as we do it, seems to be almost a little bit like in a shock state, which is, if the absolute level is high, then there is more a sit and wait behavior. And that is exactly something that we need to overcome. So there is not only the help of this paper in terms of how portfolios should be steered, how capital market players should look at carbon risk, but also almost in a behavioral sense, again, the confirmation that we need to work in particular with those who have very high absolute levels because they really struggle to get into commitments as such. What I believe one can also take from the paper is how the implementation of these commitments and in net zero pledges can be guided. As was explained, if the absolute carbon levels are very high, then the implementation apparently is lacking or may at least be timing-wise postponed. And for this reason, practically we believe one should introduce short-term targets, so not only a commitment far out, but really shorter-term targets. And we would be, of course, very, very interested whether this would then also show in the statistics a certain form of different effect in terms of the implementation as such. If I may, there would be three areas where we think one could now build on this work and on the paper. One is the pricing, the carbon price channel, how that could be included in the analysis, because we do believe that the carbon price changes, and we can have a discussion how we actually define the carbon price for this analysis, may really have quite some significant effect in the overall implementation, and certainly also in terms of the commitments and the making of commitments. Another element that for us practically is very interesting is the customer behavior that may actually come along and in here as, let's say, a factor that either accelerates or may decelerate certain forms of implementation once commitments are made. And then I have a technical remark. The true cost data, very good and let's say used in various forms. However, we in our own work have had difficulties with the aggregation on countries for scope 1 and scope 2, and we are not sure whether there may actually be some let me say inconsistencies. And I just wanted to highlight this, that we have let's say this question mark. And certainly I'm interested whether there are any observations in that direction too. So with that, once again, I do believe the paper is indeed very, very timely and from a practical perspective, very interesting. And we certainly are quite grateful that we had the chance to actually be made aware for this work and are already starting to try to build on this. Thank you.
There was already quite a lot there for us to build on from in the moderated discussion at the end, but why don't we take a few minutes first? Professors Bolton or Kacperczyk, would you like to respond for a couple of minutes before we move to the next paper?
Yes, thank you, Jinu. So this is Patrick Bolton speaking. We're in the same room because we had a connection failed, the other connection failed. Günther, thanks a lot for these comments. I mean, I think this is very useful to know, I mean, to have the perspective of someone who sees these changes happening, you know, and has to confront them on a daily basis. And I thought your comments were very much to the point. And so I just want to very quickly pick up on three of your last observations. One on short-term targets. I think that's where we have to go. Companies have made these 2050 net zero commitments. Very little is said, or some companies say very little about what that means for next year, year after next, 5 years from now, and so on. What we find in our research, Marcin didn't have time to mention that, is that the companies that have interim targets, companies that have shorter time horizons for their commitments, they're the ones who do more work. I mean, they're the more reliable commitments. So this is a very strong theme. I think the industry has to go in that direction. Investors have to demand interim, I mean, KPIs, as you put it, so that we can see more immediately how much progress is being made. So I think that's very important. On the carbon pricing channel, that's a very good question. In Europe now, we have significant carbon pricing. I mean, the EU ETS, you know, a ton of CO2 trades at, what is it now, 80 euros a ton?
Yep.
Something like that in the futures market. It's really becoming material. So this is definitely something one wants to look into. How much does that impact companies? How much does that impact risk? So we are not really set up to do this for this project, but I just tell you one difficulty you have when you try and do this is that most companies, they have some operations that are under EU ETS and then operations elsewhere. So you really have to trace back exactly how and where it bites, the carbon pricing bites. That's some of the sort of the implementation channel. But definitely that's right, very relevant. And then on your last point on the true cost data, there's a lot of stuff that can be said about the data. We didn't mention much in our presentation that the effects that we find on the pricing of stocks and the premia, return premia, they are there both for direct and indirect emissions. But the indirect emission measures that we have from true cost, scope 3 measure, they're for upstream. So we're missing a huge piece of the story, which is scope 3 downstream. We were not able to get that data. This is definitely something we want to do. That's highly relevant for energy sector, auto sector, a bunch of other sectors. So that's a big, I think, gap in our study. But with that, let me stop here, and then maybe I'll open it up for either a second presentation or come back with in the Q&A.
I think that's great. Let's move to the second paper, because it follows really nicely what this discussion that we're touching upon, which is really what is the role of net zero commitments, and that's a look ahead at what the future might bring. For that discussion, we have Professors Engle, Professors Acharya, and Professor Wang, who will present their paper on the role of net zero commitments and what that means for incentives to decarbonize and innovate. Sir Dieter Helm will discuss. So let me again briefly introduce the speakers. Professor Wang is an assistant professor of finance at NYU Stern. His research interests are in monetary policy, banking, and macro. Professor Engle is the co-director of the Volatility and Risk Institute, professor emeritus of finance. He's an expert in time series analysis and of course received his Nobel Prize in economics in 2013 for his work. And finally, Professor Acharya is a professor of economics at NYU Stern and formerly the deputy governor of the Central Bank of India. Sir Helm will discuss this paper. He is a professor of economic policy at Oxford University, the author of many books, and most recently, Net Zero, in which he addresses the actions that we all need to take for climate change. So again, as before, we have 15 minutes for the authors to introduce their paper and the key findings, 5 minutes for discussion, and then we'll turn to a larger discussion with the panel. Thank you.
Okay, so thanks a lot for that introduction and for having us. And thanks a lot to our discussant for accepting to discuss this paper. So this is very much work in progress, and so we'll welcome any suggestions. So yeah, it's a very, I think, natural segue from the previous paper and the previous session. So what we're trying to do in this paper is really understand from a more theoretical viewpoint what's the role of all these commitments by governments and firms that we see happening since the Paris Accord. And there are a number of questions that we try to tackle. Can these be useful? How do they affect the transition path for emissions and also output and GDP? So what are the costs too? Why are these commitments framed as quantity targets, and why do we see so much take-up across countries and firms once these commitments are formulated in this way? And relatedly, what are the incentives of governments and firms to commit? So coming back a bit to a comment that Jean made earlier, eventually we want a realistic model, rich model with many sectors and many things that can be quantified. But the approach we're taking here is try as simple as possible, have the minimal set of ingredients to talk about that. And so hopefully you can understand very clearly the forces going on. So here's kind of, I have a few equations just on this slide and the next one, and then it's mostly going to be pictures. So here's our theoretical frameworks. So you have production by firms indexed by I, where the production is just a function of some investment, some capital or K, IT, and so that happens over time. Emissions are a byproduct of the production. So emission by firm I is denoted by EI, and it's going to be the product of some emission intensity theta that depends on the kind of technology you use and how much you're using that K. And that leads to an aggregate amount of emissions that just integrating over all the firms I. So these emissions will accumulate into a carbon stock, or more generally greenhouse gases, Z, that leads to damages for the economy. That, so that's the traditional environmental externality. And so the carbon stock is going to accumulate because there's a little bit of depreciation, as in many models like this. But as you keep emitting, the carbon stock would increase. And now a very important part of our framework is that there's green innovation. So this emission intensity, and I'll show the role of that, is not something that's given, there's going to be a lot of innovation, and the whole point is how to induce the right amount of innovation in renewables and carbon capture. And this innovation here is very simple. It just reduces the emission intensity, theta, by some amount delta. Okay, so if you innovate by more delta, you get a lower intensity, and so therefore lower emission for a given production K. But this is costly, and this has a cost C that's borne by the firms. Okay, so C is increasing in convex in delta, but crucially, it also depends on the aggregate amount of innovation. And here we just index it by this parameter, big theta T, which denotes the technological externality, and which just says that, if there's a lot of innovation going on for many reasons, both for R&D, spillovers, also, things happening over the supply chain, do you want to innovate? Do you want to transition if your suppliers haven't, and so on? There are technological externalities that say that the more, other firms innovate, the cheaper it is for you. And so you want to also, be able to take advantage of these externalities. Okay, so as usual, we start with the first best transition. What would happen if a social planner was able to control everything, control the path for every firm of production and innovation? So this is a bit heavy in math, but basically that's the kind of objective function, social welfare, that you would try to maximize. And the key thing in this model is, as in other work by Semoglu and co-authors, for instance, there are really two externalities: one environmental, which is denoted by this gamma T, which is really the social cost of carbon, taking into account all the future marginal damages, and the technological externality, which depends on this cost function and how it's affected by this stock of technology, stock of clean technology in a way. And so these two in general are going to be positive. And so how do you implement the first best? The first best is going to be a whole path for all the firms. But in fact, you can implement it very simply with just two instruments that have to vary over time, but that are carbon prices and innovation subsidies, and both are exactly equal to these measures of the externality given by these formulas. And the crucial point here is that if you have so you have two externalities and you need two instruments. And if you have two instruments, then the policy is time consistent, in the sense that there's no need to commit to anything happening in the future. At every point in time, governments can just do whatever looks optimal at this point in time. And the next governments are going to inherit a new situation, but they're going to reset carbon prices and subsidies, and they're always going to do the right thing, and everybody's going to agree forever on the right path. And so that's the ideal world. You have enough instruments. You don't need to use these complicated commitments. Now, what happens, just to illustrate the role of innovation in the transition? Here I'm showing you kind of a phase diagram. So on the x-axis, you're going to have this emission intensity theta, the average level in the economy, and the y-axis you have the stock of carbon Z, and temperature is also going to be related to this. So more carbon or more a higher carbon stock means a higher temperature. And so if you have exogenous technology, it means that you're on this gray vertical line, stuck at the initial level of emission intensity. And so you're going to converge. You start from the black dot and you converge to the red dot. And as you converge, eventually you're going to emit less and less because you converge to a steady state level Z star, but it's very high, featuring very high temperature. So it's already better than if you had nothing, so laissez-faire. So this path features carbon taxes, but you end up at a high level. And where you end up is can be defined as net zero, because things are going to stabilize, but it's very far in the future. Now with endogenous technology, the path is going to look like this instead, where you're going to shift towards greener technology. So to the left, to this ultimate level theta star, the steady state level of emission intensity. And initially, technology is still pretty dirty. And initially it is optimal, so it's kind of a dangerous message, and it depends on where we are exactly. But initially, it's optimal to emit before the technological transition has taken place. So you're going to have an increase in carbon stock and a high price. So you have to charge high carbon taxes, but technology has not evolved yet. But gradually, you're going to have this innovation taking place and the economy moving slowly to the left. And at some point, you cross this, diagonal line, and that's our notion of, going to net zero. So basically, the time at which this green path crosses the black, line is the net zero target. So our model is very simple. So you could try to calibrate that and see whether 2050 is a good date, or you want to do it earlier or later. But basically, that would be kind of the state. And after that, you're going to be in a way net negative and converge to a low steady state, low temperature. Technology is going to keep improving, and so that you end up at the green dot, which is the new steady state. Okay, so that's the first best path, and it's achieved by having carbon taxes or carbon pricing. So it could be cap and trade and innovation subsidies, but there's no role for commitment in that work. Okay, so now to get a role for commitment, you need some constraint on some instrument. Either it's very hard to charge very high carbon taxes, the right social cost of carbon, and maybe that's closer to the US situation, where you have a lot of lobbying, as Senator White House told us about earlier. And for some reasons, there's a cap on carbon taxes, current and future ones. But in the US, you kind of see that we're using subsidies much more. Or you have some constraints on the amount of subsidies you can give, perhaps because of fiscal constraints, or but in Europe it seems easier to charge a higher carbon price, but the subsidies are not at the US level. So whatever the different countries are going to differ, but you have some constraint. And as soon as you introduce this kind of constraint, this creates a role for commitments. Why? Because you have these technological externalities and these constraints, and now you're unable to control both things at the same time. So you're going to commit to lower emissions than what would be exposed to optimal, meaning that you're going to commit to lower emissions by even more than what the first best path entails. Now, this is a binding commitment, and this requires some international agreement or some way to make it credible. Why? Because exposed, once all the innovation that you're trying to induce has taken place, you would like to deviate, and you would like to go back to a more normal, carbon tax or innovation subsidy. So if you're a country with limits on carbon taxes, you promise high subsidies now and in the future. If you're a country where, it's hard to give big subsidies, you promise, a high, implicitly a high carbon price. But the nice thing is that by committing to a quantity target, you're letting the country, choose what instrument, depending on their constraint, they're going to use. And so they choose that optimally. And so that's partly why maybe, we see quantity targets adopted everywhere, because if you just had to set the path of the carbon price, countries that, for some reasons have more constraints on carbon pricing, but would like to use subsidies, they're not going to be willing to take that road, whereas if you just set, it's a quantity target and you achieve it whatever way you want, some countries are going to choose to, commit to high subsidies, and some countries are going to choose to commit to high carbon taxes. So what are the resulting, equilibria? So here, I'm just showing some illustrations. So on the x-axis, you're going to have the strength of the innovation externality. Basically, if you're at zero, this parameter chi at zero means there's no externality. So all this is irrelevant because carbon pricing achieves the first best, and you don't need subsidies, you don't need commitments. So what is the first best like? Well, as you increase the externality, output decreases, total emissions decrease, and welfare increases. So here you don't really have units on the y-axis because there are numbers behind this, but the model is not yet rich enough to really take them at face value. So just think about the direction. So output decreases. Why? Because you innovate more, and so by the way, this is a case where we're not saying, oh, investing in green technologies would just be such a big demand shock that even output goes up and so on. So here you have a cost of doing this, but it's optimal to use this and to lever the technological externality because that helps you lower emissions, by a lot, really. And so in terms of welfare, it's better. So that's the first best, outcome if you have these two tools. Now, what if you what if you don't have any subsidies and you don't use commitments? Then you have much higher output, much higher emissions, welfare is lower. And the government commitment is kind of get you in between, And here it's a commitment to high carbon tax. So think more maybe of Europe, but you could do the same for a commitment to higher subsidies. So it's gonna get you kind of in between. Now, in the last part, what we want to talk about is this firm commitment. So you also see a striking rise in firm commitments. Are they useful, socially useful, what the private incentives are there substitutes for government commitments? So these are the kinds of questions we want to tackle. So the first part is that the first result we have, which is of course coming from this very simple setup, that small firms won't make commitments. Why? Because the only reason to make commitments is to change the equilibrium somehow. And if you're small, you won't be able to change anything. So there's no reason to make a binding, costly commitment. So it's costly because you lose flexibility in the future. For different reasons, it's going to be costly. This is also true if you have consequentialist ESG stakeholders, so workers or investors care about that, because in this simple setting, without all the kinds of uncertainty and signaling, everybody will anticipate what you would do even without the costly commitment. So if investors think you're going to decarbonize, they will give you the premium even if you don't commit. So that's the baseline. What about large firms or coalition of firms? So suppose you have a large firm, and this should really be viewed as a coalition. Maybe in the background you have large investors like BlackRock. So that has a size mu, and 1 minus mu of the firms are small, atomistic. Now, the large firm can act as a stackable leader in green innovation. So the whole point is that the large firm can undertake a commitment that will shift the equilibrium. And why is it optimal? Because it will induce more innovation by the remaining 1 minus mu small firms. So now, you have these externalities that ends up lowering the cost of innovation for everybody, including the large firm. That also lowers the average emission intensity in the future and the carbon taxes. So these are the reasons to commit if you're part of this coalition of mass mu. And so what this achieves is that just like government commitments, you're going to go not all the way to the first best, but kind of in between no commitments and the first best. Now, in the background, I'm not showing everything, but the way this achieves this output is very different from the government commitment because it's not through a carbon tax. So, the production is high, but you have a lot of innovation too. And so that's why on net output looks similar to the case of government commitments, but the decomposition is very different. So comparing to government commitments, welfare in this case, where I have mu equals 1/2, so a very large firm, or coalition, here it's chosen to be kind of identical to the case of government commitments. But it's achieved by having higher output and higher emissions. Now, if you change the size of the coalition, this is going to matter for the comparison between firms and government commitments. So this is just to show you, I skipped that. So the large firm has an incentive to commit because it is getting a higher welfare as a stakeholder leader than in the Nash equilibrium. What about if you change the size of the coalition of the large firm? Well, the baseline was 1/2. If mu is very low, so 0.2, and eventually if you go to 0, you're back to the small firm case where you don't get anything, so you're very close to the no commitment case. And here it's a case where governments don't commit either. So committing to the government target would yield the blue welfare, which is much better. Now, if you at some point, if mu is large enough, and if you have a very large firm or coalition, you do much better than even government commitments. Why? Because this is voluntary. And so eventually, suppose the mu gets very, very high. So it's as if you manage to coordinate the whole private sector and they're just going to replicate the first best allocation. Okay. So just to conclude, it's a simple model showing the key role of endogenous technology. You have two externalities. So ideally, you would have two policy instruments. Binding commitments are useful and only useful when one of these instruments is constrained. Depending on the country, it could be the subsidies or the tax. quantity targets as commitments are very useful because they let you partly overcome this lack of instrument, and framing them in terms of quantities is nice because it lets the countries decide, which is the better way for them to reach that target, either adjusting more the intensity or the production, or equivalently through the subsidies or through the carbon taxes. Government commitments are therefore an imperfect substitute for innovation subsidies. Firm commitments in the absence of government commitments can be very useful. But small firms wouldn't do it. Only large firms or coalitions may. And, if that's large enough, you're going to even dominate government commitments. So there's no clear ranking between the two, and in fact, the larger the coalition, the more the incentives to join it. And so next steps, I didn't mention this much, but initially in the framework, you see everything was indexed by I, so you can have different firms starting from different points. So we're thinking of kind of looking at these results that Marcin presented too, on different firms are going to have different incentives to commit. So you have heterogeneity in many dimensions, productivity, emission intensity. We want to introduce these short-term targets as ways, to once you have, other kinds of limited commitment by the government. Basically here, I didn't really talk about credibility. So everything you can view would be what's the value of having ways to make these commitments credible. And of course, international issues. Okay, so thanks a lot, and I look forward to the discussion.
Okay, well, thank you very much for asking me to make some comments, and it's a great pleasure since this was an excellent paper and extremely interesting and very thought-provoking. And I read it, and then I read Patrick and Martin's paper and their earlier paper on firm commitments, all of which make enormous contributions to this literature. I'll try and keep my comments within the 5 minutes, but it's very hard to do that given so much material in this paper. The first thing to say is that the intellectual problem here, the economist problem is, why would anyone make these commitments? I mean, these are externalities, these are public goods, private profit maximizing companies. What are they doing this for? And I think that needs explanation, and everything I'll say will be focused around a kind of notional idea of thinking about how you advise the chief executive of a company what to do in this context. So the first thing, I'm going to break up 3 quick comments. One is about the Paris Accord and the credibility of the government side. The second one is on the Pigouvian taxes. And the third one is on the Stackelberg approach and an alternative way of explaining what companies are doing. So first of all, if you sit in any boardroom, the question is, do the governments mean it? Are we actually going to be on a transition to climate change? Does COP26 mean very much, etc.? And you have to say immediately, A, we're not on a transition. We added 2 parts per million to concentration of carbon in the atmosphere last year. We've done that every single year since 1990. And indeed, it's been slightly higher in the last 10 years per year. Even the lockdowns made no difference. And climate change is about the concentration, the stock of carbon in the atmosphere, and that is net of sequestration and emissions, and it is not territorial. And what we have is a set of territorial carbon production targets, nothing to do with sequestration, nothing to do with trade, and therefore it's not surprising that in Europe, for example, you can go towards net zero territorial targets, but actually increase global warming by essentially switching from domestic production to imports. And over the last 30 years, that's a pretty good explanation of what's going on. So for any firm, the first question is, are governments' commitments under Paris, etc., properly specified to the problem? And secondly, is it making any impact on the problem? And the answer to the last bit is definitely no. And last year is really clear evidence. So I'm sitting in the company, I'm thinking, so what should I do? So you might think, well, governments might then put the Pigouvian taxes in place. And that paper is, very interesting for a particular reason amongst many others, which it does both innovation and the externality of the carbon price. Well, here we do have Pigouvian instruments. They're just not very good. So on the Pigouvian externality price, the most important price is the price of oil, and the price of oil is not related to its marginal costs. and therefore is a proxy for a carbon tax. So the marginal cost of oil in a rational world will be about $5 a barrel. The current price is 108. In Brent, it's a bit lower in WTI, but for most periods, it fluctuates wildly, and it's incorporating carbon through the economy. And remember, the world's economy is 80% fossil fuels and has been the same since 1971. So this notion of a transition, we aren't making any dent whatsoever in those fossil fuels. They pervade the economy, they pervade the factor inputs, and they all incorporate the OPEC tax within the frame. And then there are emission trading taxes on top. So in fact, the carbon taxes in Europe are extremely high. And if you add the OPEC component to the EU ETS, you get a price which looks like a pretty credibly high carbon price for companies to operate against. And then we have to remember that innovation, R&D subsidies are widespread, inefficient, imperfectly targeted, but they're not zero. So we have imperfect Pigouvian steps, and then you come to the companies and you say, well, what should the companies do? And the paper, and in the Patrick and Martin's earlier paper on firm commitments, which, like their paper they presented just now, brilliant papers, okay? When you look in there, what you observe is that this great PR exercise on all these companies committing to net zero targets, etc., is less than it seems. So in the Stackelberg framework and in the results in this paper we're discussing, the key insight is that it's essentially companies with market power that are doing stuff. And the insight, amongst many others from the firm commitments paper, is that the companies are doing stuff are the companies where it's not costing very much to do much. And the corollary of that in the in this paper is that small firms aren't doing very much. Now, let me take an alternative approach. Let's assume that we've got a monopoly, or rather, we've got a quasi-monopoly with lots of market power, and you're worried about hit and run entry. What you want to do is raise the entrance cost. This is, you know, stuff of conventional theory of the firm, etc., and competition analysis. Okay, so what better than to up the cost by committing to net zero and then trying to disadvantage entrants who can't face the costs of doing that, have lots of structural adjustment costs, are in the small firm category, etc. It will be a very good way of improving your profits by deterring entry and enjoying the benefits of market power. And it seems to me that that rather more simple explanation would be quite helpful in working out what's happening. And if you add to that, there are industries in which the costs of decarbonisation are pretty low. It's a bit like the costs of entry into the, I don't know, household shampoo market is very low. But there you jack up the advertising costs as a barrier to entry. Maybe you jack up the requirements on standards, etc., to prevent entry. So I think that's worth looking at. So I had lots of other comments, and I've taken just over 5 minutes, so I'll stop at that point. But to reiterate, these are excellent papers.
Thank you for that. There's a lot here to discuss, and two really important papers, and only around 10 minutes left for discussion. So let's do this. I think there are three actors that we've touched upon in the papers and the discussions: policymakers, firms, and investors. And so I have a couple of questions around that, and we'll try to keep this brief because we only have around 10, 12 minutes left. For Professors Bolton and Kacperczyk, for policymakers, what implications should policymakers be taking from the observation that there is a carbon price, and that carbon price might vary across sectors, across firms, across geographies?
Sorry, this is for us, right? Yeah. So you're saying what's the implication of a carbon tax for?
No, the observation that there is a carbon premium.
Oh, the observation that is a carbon premium for policymakers. the policymakers have one more argument to bring to the table. They say that it's in companies' interests to decarbonize because that's what investors want. So in the early days of climate change mitigation debates, you had government, maybe civil society with green parties and so on, supporting government action. And then on the other side, you had a uniform coalition of business and investment opposing government intervention. But what you're seeing now is that this coalition is no longer homogeneous. And you're seeing that for at least for a very large constituency of investors, institutional investors, long-term investors, long-term asset owners, it's in their interest to see government intervention, to see carbon taxation, to see limits imposed on carbon emissions. And so I think for governments, they want to leverage capital markets, they want to leverage that constituency to push their policies. I think that would be my quick answer to your question.
Maybe just to add one extra observation, like these days we are debating a lot this regulation on disclosures, etc. And you could take a very naive kind of view and say, why does it even matter? So I think what's important to recognize is that actually investors are sensitive to this basically metrics of transition risk. So to the extent that we observe the meaningful change in the cost of capital of these companies, this regulation that actually the policymakers are undertaking can actually have a bite, because we have a lot of regulation that oftentimes is just simply a washout from the perspective of prices and economic movements. But here we actually have a regulation that could be potentially meaningful. Of course, we don't know exactly the full extent of these effects, but knowing that actually it does matter, I think it's a good starting point for actually even thinking about it.
Dr. Thallinger, maybe you could respond, because the idea that this might help drive changes in investor preferences, investor expectations. Perhaps you could comment on what is the kind of information that investors need to differentiate between firms, and in particular, the quality of their commitments. This also relates to a question from the audience, which is, yes, we're seeing growing mandatory disclosure, the SEC, the EU, we're moving in that direction. What kind of indicators for transition risk should we expect from that kind of disclosure? Should we differentiate between mandatory versus voluntary disclosure? There was a lot there in that question about investors, but perhaps you can take parts of it in your response.
Yeah, thank you. Look, the ISSB, the arm of the ISP, let's say what is promoting IFRS. The ISSB under Emanuel Faber is working on corporate value and the climate risk aspect to it. So this is going, I believe, in the direction of our discussion. And this is a very good step, absolutely. For let's say, those who manage entire portfolios, however, we need to have not only the, let's say, outside in, so climate risk on corporate value, but you also need to have the inside out view, which is the company, let's say, onto, let's say, the entire environment. Why is that? Because the net zero commitments that the investors actually have only starts to be managed, let's say, along that dimension. So in the direction of answering your question, what do we really need as investors? We do need clearly a form of, let's say, emission reporting about emissions, but you also do need how these emissions are going to change or are supposed to change, so that we then can say, okay, in the aggregate, how is our portfolio going to change? And what we had before, let's say, Professor Bolton mentioned this, the shorter term targets are enormously helpful, because then we are going to see something like track records evolving, which is a language that we investors understand, and that builds credibility and trust. And then we can start to use this in a certain form. That said, however, let's say to Sir Helm, yes, unfortunately, we do not see any transition. And even if we have this, and even if we have these portfolios and the management of it, if the overall economy starts and continues to grow at these emission levels that we have, again, transition will not be there as such. So we need to have actually further discussions, but that's perhaps too much, and I should stop here.
And let me also give a question to both Sir Helm and Professor Wang, which is both, how do we think about the credibility of firm commitments, part one, but also what will make these firms accountable? We've been mentioning perhaps shorter term commitments would make a difference. Investor preferences as they change could make a difference. But I'd love to hear your views on really what makes commitments accountable.
Do you want me to kick off on that one? I mean, a lot of what's already been said, shining the torch, measurement is what matters. The scope 1, scope 2, 3, the point was made that there's a great deal of difference between upstream and downstream components of that. And the truth is, we don't know what the carbon footprint of any firm is. You don't know what your personal carbon footprint is. If you wrote your carbon diary down for a day, which is an exercise I recommended, you'd be quite surprised. Would you include the palm oil, for example, in your breakfast cereal, etc.? So we're only getting a hazy grip on this. And there's one dimension of this which hasn't been met, which I think is very important. A large number of companies who make these commitments are relying on the idea that they'll be able to offset some of those emissions going forward. And I've done a lot of work on offsetting, and it has to be said that it's pretty primitive, it's pretty crude, and it's full of a lot of what will be called greenwash. So the job for the investment community is to keep asking the questions, but for the companies is to come up with a genuine measure of estimating their impact on emissions and their damage to sequestration. And if you want, alongside the observations that we went up 2 parts per million last year, and that we're still 80% fossil fuels, the fact that the Amazon became a net emitter of carbon goes quite a long way to explain why that side of the equation leads to the 2 parts per million last year, even when emissions fell so strongly during the lockdowns. So I think it's a very long way to go. And I think the offsetting, which companies deeply rely upon in their estimates or think they're going to as they get out of jail card, has not been properly taken into account yet.
Maybe just tying back to our model. So first, thanks a lot for the excellent discussion and all the nice words. And yeah, I think that this view on market power is a big component. I mean, that's our answer. It's you have to make it, privately optimal for them to do it, and they have further gains down the road. And the reason we say small firms don't gain anything is because, well, one view would be you're signaling something, and the view, very pessimistic view that we're taking, is that what's going to be the cost of not meeting that? It's going to be low. So in fact, there's no way to signal because everybody would do it. And so that's why we found another rationale for this. But if we are able to come up with some reason, even for the small firms to commit, thanks to the stigma that would come from that meeting the commitment, then you get an even better world than the one we have. So we're kind of taking the extreme view where you don't have any of these, and so you have to really have your private incentives coming from the fact that you're a large firm and so on to commit.
Great, thank you. And then I reserve the final question for Dick Berner.
Hey, thanks, Jinu, and thanks for a wonderful session. My comment follows on from the last comment, and that is primarily for Olivier, but for all of you. Could we think about the combination of both firm and government commitments, albeit second best to a carbon pricing regime, like a carbon tax plus subsidies? Could we think about that as more powerful in some ways than either of the two alone? In other words, a government commitment offers some credibility or perhaps a way to hide behind the problem and to solve the collective action problem that exists because only firms with market power are going to see that to their advantage And could it offset some of what Sudhita talked about in terms of engaging in that because it just enhances their profits and their market share?
Yeah, so
Yeah.
I don't know if we're out of time, but very quickly to that question, which is really excellent. That's the direction in which we want to go. And one area where you see this happening is with central banks suggesting decarbonization pathways and offering that as a coordination device to rally around commitments by banks on the one hand and by companies on the other, and that's how you link the national commitment. So in the UK, you have a legal commitment to net zero by 2050 for the whole country, and then you have the Bank of England stepping in and saying, "Okay, how do we get there? Tell us how you get there. Give us your decarbonization pathways." And then using the scenarios that it offers to, suggests to banks and the corporate sector as a way of coordinating commitments and decarbonization.
Yeah, and I was going to say, yeah, in our model, we also have this kind of complementarity. And in fact, it breaks a little bit the asymmetry, which is in countries where you expect most of a government commitment to be met by carbon taxes, pricing, rather than subsidies. That's where firms have the larger incentives to commit themselves. And we're exploring this further, but so it's also going to be more subtle in the way. What is the way that the government meets these targets?
Maybe I can bring up one result that Patrick and I have found in our paper that we did not discuss, which is an interesting interaction that you find is what happens to the firm commitments when actually governments intend or implement their commitments. And what you find is that a very interesting dichotomy, which is upon announcement of commitments, like you look at INDCs, the incidence of firm commitments goes up, but once they get implemented, it actually goes down. So essentially from the firm perspective, they think of it as a basically substitute rather than the complement in the way how they are gonna basically follow on the decarbonization. So there is a little bit of a free rider problem, I think, that is potentially hiding behind all of this.
We are unfortunately at the time for this panel. It was too much for an hour and 40 minutes, but thank you to our speakers, and also thank you to the audience and participants who've been listening in. This has been recorded, so it's available as well online. But thank you for today.
Thank you very much. Thank you.